Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio since 1977. This is the fifth part of a six parts presentation on how to protect your portfolio from devastating events. In this presentation, we're going to deal with specific investment concepts and how they relate to the business cycle. Then in part six, we'll do the how we're going to use all this information that I have discussed with you. I would like to remind you that my objective is not returns, but the main objective is to manage risk. And because I think if you manage risk, that is the probability of losing money, your returns will be very satisfactory. And you manage risk by reducing the portfolio volatility, and you do that by being in the right sector and asset classes. In this section, I discussed how do we recognize volatility and how do we use volatility in the performance of a specific investment to choose and decide if that investment is the right one for you. The point is that if you watch the volatility of let's say the price of a stock or bonds or whatever, it tells you if you are in the right or the wrong investments for that particular phase of the business cycle. Let me give you some examples. Let me remind you of what I mean by business cycle and strong growth and slow growth. This is the business cycle. This is how the economy is growing. This is very strong growth, then it slows down, very weak growth in phases 401, then growth picking up again, and then you have strong growth, which is above the growth potential. The growth potential for the United States is around 2.53%. The investment strategy, as I told you in previous presentation, at around 2-3 in phases 2 and 3 is totally different from when the economy is in phase 4 or 1. Let me give you some examples. When this presentation was made, as I mentioned before, the economy came out of the Great Recession, and this is the orders, by the way, of durable goods orders and non-defense capital goods, excluding aircraft, and they grew very fast. But since 2011, here, orders declined. So that told you that the economy was downshifting, like it was downshifting here and like was downshifting here. So let's see now what happens. So clearly we are here in phases 4-1 in around this time. Again, since 2011. This is the year I want you to remember. If you recall from a previous presentation, I told you that in 2011, commodities, all the commodities declined. This is, by the way, is 2011. And notice that all the commodities, if you go back to the previous presentation, all the commodities peaked somewhere in this period, including gold. Gold peaks around May and has been declining ever since. Now look what happens to Caterpillar. Caterpillar is clearly a mining company, so is a function of commodities. But look at its volatility. Up, down, up, down, up, down. But overall, since 2011, this stock did not do anything. Keep that in mind. Caterpillar, my point of this chart is to show you that if you are in the wrong assets, you're not going to make money. Not only that, but you're adding a lot of volatility to your portfolio. Again, Caterpillar peaked in 2011 when commodities peaked because the economy was slowing down. This is the relationship you have to remember. Slow down in the economy, peak in commodities, and then this kind of stocks are not doing well because the economy is slow. This is the kind of stocks that do well when the economy is strong. This is when the economy came out of the recession. Look what happened to Caterpillar. Moved from 55 to 110. And everybody got excited, but this is because the economy was strong. When the economy started slowing down, Caterpillar did not do well. This is another stock, Freeport-McMoRan, which depends on copper and gold prices. Again, same idea. That was very strong when the economy came out of a recession in 2009, 2010. Great, like Caterpillar. But look what happened when commodities peaked in 2011 and the economy slowed down. Big volatility, and the stock eventually did not do anything. Again, the point being, when the economy slows down and you are in the cycle that is a downshift and it goes into phases 4 and 1, this kind of commodity stock, commodity sensitive stocks, do not perform well, industrial stocks in general. This is another stock, oil. So we looked at mining, we looked at copper. Now this is an oil company. Look what happened. It's all the same charts. Did you notice that? They're all the same charts. They're very strong coming out of the recession, but then because commodity was strong, the economy was strong, but when the economy began to slow down in 2011, go back to the chart of durable goods orders, then all the stocks went down. All the stocks went down. So you add in volatility. By being in the wrong asset, you add volatility and you are not performing. Again, why? Because since 2011, the economy started growing slowly. That's the important thing. When the economy grows slowly, you have to be in the right asset classes and therefore in the right stocks. What are the stocks that do well when the economy is slow and slowing down and grows slowly? Go back to the previous presentations that I made. I don't remember if it is part 4 or yeah, it's probably part 4, where I told you which asset classes do well when the economy is weak. One of the things that do well is consumer staples. And look what happened to consumer staples. They didn't care that the economy started slowing down in 2011. They kept on growing up with very, very low volatility. Even if you make a mistake here, you have a little downdraft. But if you make a mistake with Caterpillar or Murphy-Oil or one of the stocks that are commodity sensitive, you lose a ton of money. So this is why it's so important. When I started in part 1, I said you have to be in the right asset classes with low volatility. You have to manage risk by being in asset classes with low volatility. And XLP, the consumer staples, are the right asset classes when the economy slows down. Another asset class when in a slow period, when the economy is growing slowly, is healthcare. And look at what happens to healthcare. Same as XLP, going up, steady, low volatility, the economy is slowing down, everything is fine. If you look and compare this to the charts of Caterpillar or Deere or Murphy-Oil or whatever, they go all over the map. Instead, look at this steady growth, because you are in the right asset classes and then you're right in the right sector when the economy is growing slowly. Another asset class and another investment that is very good when the economy is weak is corporate bonds. Look at corporate bonds. I'm not talking high yield. I'm talking corporate investment grade corporate bonds. Forget about high yield. High yield perform exactly like the stock market. So they might have this a little less volatility, but that's what they're very closely related to. These are corporate bonds. Forget about what you hear about hyperinflation and all that kind of stuff. Doesn't make any sense. When you are in bonds, when the economy is weak, commodities are going down, the Caterpillar and the Deeres of this world, they go down, but bond prices go up. So as long as the economy is slow, that's a safe, low volatile investment. Again, low risk investment. So corporate bonds should be part of your portfolio in a weak economy environment. What is the point of this part 5 of my presentation? That to minimize volatility, you have to select investment doing well in that particular phase of the business cycle. It doesn't make absolutely any sense to buy or to invest in sectors or stocks or asset classes that there is tremendous evidence that they will do poorly in a slow economy. You want to be in asset classes that do well in a weak economy environment. Well, I want to thank you very much for staying with me through part 5. There is the last part in this series of presentations is part 6. Part 6 deals, okay, how do you put it together? How do you set up a portfolio and what do you do? What are the tactics? What are the strategies and so on? So hopefully you will look at part 6. Again, thank you very, very much for listening, and I hope to see you very, very soon. So long.